Today I wanted to talk about a trip I made to the US in February, where I spoke to corporates, institutions and Federal Reserve officials. I think there are a number of really important fundamental signals that came out of that trip. Of course, since the trip we've seen these huge movements in markets as markets become a lot more concerned about the coronavirus. The economists had a very positive view about the US economy. I have to say that at the time, the general consensus view around the coronavirus was that the factories in China would be starting to pretty much fully reopened by mid-March, that the travel bans were eased and there'd be no spread of the coronavirus globally. So that was the consensus view, and as a result people were generally comfortable that the slowdown associated with corona would be fully reversed over the course of the next few months. So we focused on the fundamental US economy, and the view with regard to the US economy amongst economists was that it was still in very good shape, that the Federal Reserve would remain on hold in 2020, and quite a few of them expected that they'd actually be raising interest rates in 2021. When I spoke to Federal Reserve officials, the most important point that came across was their concern about their inability to achieve their inflation target. As you know, the inflation target for the Federal Reserve had been interpreted as being 2%, and over the last 10 years they've only achieved that 2% on a monthly basis in about 12 months of the 10 years. So they've been consistently underperforming on their inflation target. And what they want to do now is they want to communicate to the market that 2% is not the target, 2% is the average for the target. So in other words, having spent so much time below 2%, they want to spend a lot of time above 2% on inflation. That says to me that they'll be prepared to run the economy harder than one would have expected if the inflation target was 2%. And there was a lot of talk about being accountable for this target. When I saw institutional investors, the attitude was somewhat different to the fund manager, to the economists. They do expect that there will be a rate cut this year. They're expecting 1 to 1.5 rate cuts. And of course the thinking behind that was that with this revised attitude towards inflation, there was no chance of a rate hike. So if you've only got two possibilities, a rate cut or no change, then you have to price for somewhere between those two possibilities. Others were even more adamant that there'd be rate cuts if there was a major change in the share market. The feeling being that the Fed is almost entirely driven by progress in the share market. So I came away from those meetings believing that our view that there will be 3 rate cuts this year was quite respectable, that the US economy was likely to be slowing down to a 1.5% pace rather than the 2+ pace that the Federal Reserve is expecting, and that we were still comfortable with our 3 Fed rate cuts. Of course, in the last few days we've seen the consensus view around the coronavirus start to change. I don't think people are too concerned about the fact that the factories will start to reopen fairly aggressively over the course of March, and I think that travel bans are still considered to be likely to be lifted. But the big concern now is whether it's travelling all around the world, with issues around Italy, Iran and Japan and South Korea. So that remains the big issue now, and of course whether the Federal Reserve will react immediately is a big question mark. Markets now have a little more than 2 rate cuts priced in, but we expect that they'll be waiting to see developments over the course of the next few months before they be making that move. So let me summarise. The most important point, I think, is this changed attitude towards inflation, which gives the Fed more scope to cut rates, given that they feel that they're just not achieving their inflation objectives. That, of course, if we superimpose that upon the developments we've seen in the share market in the last few days, certainly points to our 3 Fed rate cuts this year being very likely to be achieved. Thank you.